In this video, we'll look at the short-term and medium-term impacts on markets of President Trump's diagnosis with COVID. And if you do want to keep abreast of what's going on in markets and also the economy, then sign up for our free weekly market roundup. There'll be a link in the description below me and above me. So let's look at those impacts in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. We found out about the diagnosis via this tweet on October the 2nd, where Trump announced that he and the First Lady had tested positive for COVID-19 and that they'd be beginning their quarantine and recovery process immediately. The physician to the president, Sean Conley, then released this letter, which didn't really give much more detail, but did say that he'd maintain a vigilant watch over the president and the First Lady, and also that he expected the president to continue carrying out his duties without disruption while recovering, which sounds very similar to what happened to Boris Johnson, who for a long time seemed to be asymptomatic and carried on working, but consequently his symptoms worsened. So hopefully that won't happen to the president. If we enter President Trump's details into this calculator, the biggest risk factor is his age, which is 74 years old, and his body mass index, which is about 31, only adds 1 year to his COVID age, and the estimated mortality rate remains very low, at between 3% and 4%. So the most likely outcome is that President Trump will simply recover from this infection. So what I'm going to do is to split the effects into short-term and medium-term impacts. It's already clear that this will be a classic risk-off move across markets. So in the case of risky assets, such as equity, high-yield credit, and investment-grade credit, we'd expect asset prices to fall, with the greatest fall in the riskiest assets, which is equity, and the smallest falls in the least risky assets, such as investment-grade corporate bonds, and safe haven assets such as US short-term treasuries, but also gold and long-term treasuries would be expected to rally, with long-term treasuries rallying the most and short-term the least, because short-term treasuries behave very much like cash. Since the equity market sell-off in March, volatility spiked at above 80% if we look at the VIX index, but even though equity markets have rallied strongly, we have seen repeated bouts of volatility, so certainly in the short term, as equities tumble, I'd expect the VIX volatility index to increase significantly. Now over the short term, I'd expect updates on the president's health to be the primary driver of equity and bond markets. But what I'd also expect is that this is going to be a fairly short-lived sell-off. And if, as seems likely, the president simply recovers, equities would recover very quickly. I think what's more interesting is to look at the medium-term impact. These are the earnings per share for the S&P 500 from FactSet. The blue line is the earnings that we've already observed, finishing with Q2 in 2020. And we're just about to start the Q3 earnings season, which will be very important because we should see a steady rise in earnings. But according to analyst estimates, it'll take 4 quarters before earnings approach levels they were at before the effect of the pandemic in 2020. And that leaves equities exposed, because although the S&P has recovered very quickly after the sell-off in March, earnings certainly haven't. And if we look at the year-on-year changes for those corporate earnings, they were flat for 4 quarters even before the crisis. And it won't be till the beginning of 2021 that we start to see year-on-year increases in corporate earnings. And markets are expecting a huge bounce back in Q2 of 2021, with a year-on-year increase of 44% off a very low base a year previously. And although valuations have fallen slightly, twice now this year, they still remain at very high levels. So without this fundamental support for markets, this event could act as a catalyst, triggering a larger sell-off. Whether that happens or not really depends on what happens to the economy, but also what happens in the 2020 election. And of course, this news will play into the result of that election just as it does into financial markets. Now, of course, election polls are notoriously unreliable, but it's notable that every single poll currently puts Biden in the lead above Trump. And this is based on a list of polls published by CNN as of October the 2nd. Fortunately, betting sites provide a much more timely measure of the popularity of the candidates. And one of the outcomes of those presidential debates was that it increased the probability of a Biden win according to betting odds. So hopefully President Trump will have recovered in time for at least some debates before the actual election. In polls of the electorate, many people believe that Trump would be better for the economy than Biden. However, historically, the average growth rate under Democratic presidents has been significantly higher than the growth rate under Republican presidents. Here you can see it broken down by president from Truman up to Obama's first term, because this paper was published in 2015. The asset manager Liberum has also published these statistics on how the stock market does in the US under Democrat and Republican presidents. And in this 60-year period after the Second World War, the return under Democratic presidents has been significantly higher than that under Republican presidents. And looking at the entire period since the Second World War, the pattern is very similar. The rating agency Moodys has done an in-depth analysis based on 4 possible scenarios for the election outcome. Their baseline scenario, which they estimate has a probability of 40%, is that Biden will win, but he'll face a Republican Senate. And that will likely limit the reforms he can put into place once he becomes president. Moodys thinks there's a slightly lower probability of 35% that Trump will win, but he will also face headwinds because the House has a Democratic majority. And if that were to be the case, then we'll see many of the current policies simply being extended, such as the trade war with China and a clampdown on immigration. The last 2 outcomes are either a Democratic sweep or a Republican sweep, which is much less likely, where both the Senate and the House both have a majority that matches the president. And those 2 outcomes give the biggest divergence in terms of economic outcomes, but also what happens to markets. In the case of a Democratic sweep, Moodys expects that stock prices would rise, but this rise would be limited by high valuations. We already saw that the price to earnings multiple remains very high, but they also expect fairly slow growth in corporate earnings. And the reason for that, in the case of a Democratic presidency, would be that Biden would favor benefits for workers at the cost of shareholders. The pendulum in America has swung very far to favoring corporate earnings going mostly to shareholders, and Biden's policies would try and reverse some of that shift. But if you're paying your employees more, then your corporate profit would fall. If instead we have a Republican sweep, then the outcome is actually very similar. But in this case, the profit growth is going to be limited by slower economic growth. Looking at the GDP under those 2 outcomes, the Republican sweep is in red and the Democratic sweep is in blue, with the current policy being very close to the Republican sweep and the baseline having slightly better outcomes in terms of growth. In fact, the recovery for both jobs and GDP would be much more rapid under the Democratic sweep scenario. What's also interesting is if we look at the S&P 500 forecast from Moodys. Under the Democratic sweep, the returns on the S&P 500 will be slightly better, but there really isn't a huge amount of difference between these 2 outcomes. That's because the S&P is being held back by those very high valuations, and in the case of the Democrats, a shift towards higher wages, which hurts corporate earnings, and in the case of the Republicans, lower economic growth, reducing profit growth. So to summarize, try not to be caught up in the hysteria of the news flow. If you do have a portfolio you're happy with, then you should probably just stick with it. It's very unlikely that once the sell-off starts, you'll be able to do some tactical trades which will avoid a loss. If you do feel tempted to sell all of your equity, then take a deep breath, maybe go for a walk or whatever it is that you do for fun, and sleep on it. The worst thing you can possibly do is to sell into a short-term correction, because then you'll probably miss out on the upswing. And as always, it remains the case that equity markets will eventually recover. And the best course of action for most people is simply to do nothing and let markets do their thing. I think that Moody's analysis is really interesting because it shows there's not a huge difference in the S&P 500 according to whether we have a Biden win or a Trump win. And there's a more general lesson here, which is that most of the time we can just ignore what happens in the news, even for something as extreme as this news story. But for most people, it's about finding an asset allocation that you're happy with. So please do support us. You'll find a link to Patreon in the description below me and above me. And as always, thank you for listening.